The issue of roll yield in commodity markets is quite topical at the moment. Effectively what roll yield is, it's the actual cost of buying a futures contract and rolling that contract forward in order not to take delivery. We actually have the obligation to roll contracts forward if we buy exposure to crude oil, for example, and don't want to take delivery of physical crude. We actually have the legal obligation to roll that contract forward in order to avoid physical delivery. Now, there's an actual cost in rolling a contract forward, and that's called the roll yield. Now, depending upon future prices, that roll yield can either be positive or negative. And the two environments that exist are what's called the contango environment, where you have rising forward prices, which results in negative roll yield, and the backwardated environment, which results in falling forward prices, and you pick up a positive roll yield by rolling contracts forward. And from a practical perspective, what that means is that if a market's in backwardation, future prices are lower than current prices. So the cost of actually rolling involves selling out at a current price and then buying it at a lower price, realising a positive roll yield or a profit on rolling. You have the opposite effect when a market's in contango. The cost of actually rolling from a contract which is, say, trading at $70 a barrel to a forward contract which is trading at $71 a barrel results in a $1 loss on that particular contract. In terms of the history of markets being in contango and backwardation, if you go back 50 or 60 years and look at commodity markets generally over the long term, markets have spent the bulk of their time in what's called the backwardation or backwardated environment, which means that there has been a slight positive return from roll yield over that period of time. However, what we've seen over the last 10, 5, 2 years and of course over the last year and even year to date is that markets over that period of time have actually spent the bulk of their time in what's called contango, that contango environment, which means that roll yield has actually been negative, and it's actually been quite a big drag on passive commodity indices, which typically get their exposure at the front part of the curve. And we'll actually hyperlink some charts to this discussion just to sort of highlight the difference between the two environments. Effectively what a rising forward curve represents is supply. In a supply-constrained environment, what you typically see is markets trading in that sort of backwardated environment where a market basically has excess or oversupply, which is what you're seeing, for example, in markets like natural gas. You'll typically see those markets trading contango. And effectively what the forward curve is a representation of the storage cost, amongst other factors, of holding a particular commodity and storing it going forward. Now, given, for example, using natural gas as an example, given the massive excess supply in natural gas markets, it's actually becoming a very, very expensive commodity to store. And as a result, you're getting quite aggressive rising forward prices. Compare that to, say, a market like copper, which is in high demand at the moment. It's very supply constrained. Markets like that obviously don't have the high storage costs at the moment purely because it is in high demand, and the cost of actually buying copper and holding it isn't as expensive as, say, natural gas, where there is excess supply and great competition for storage facilities. We're now seeing, for example, supply constraints creep into other markets like sugar, which is obviously in high demand at the moment because of adverse weather conditions in both India and Brazil. We're seeing supply constraints creep into markets like lead and some of the other industrial metal markets. And where you basically get those supply constraints coming in, you typically see those markets start to trade in backwardation, which again is a reflection of the forward cost of storing those particular commodities. In terms of how we actually enhance or mitigate performance based upon whether markets are in contango or backwardation, is based upon our ability to trade across the curve, or in fact not take a position if we think roll yield is such that it's going to wipe out any potential return. And natural gas is, again, referring back to that particular example, as a market where the pure cost of holding natural gas and rolling it forward right now, based upon the forward curve, would result in losses of 60 to 70% just on that one position in terms of the actual cost of holding it and rolling it forward on a 12-month basis. Markets like sugar, for example, copper, lead, which are experiencing supply constraints, have moved back into what's called the backwardation environment. So the cost for us in terms of buying that particular position and rolling it forward actually realises a positive roll yield. So we're not only benefiting from the upward price movement in that particular commodity, we're actually picking up a second profit stream from the roll yield. And with commodity markets, there's effectively three return streams that you that you achieve when you buy a futures contract. You get the collateral return, which is effectively the underlying interest rate, whether it's US denominated or Aussie denominated. Our particular fund is Aussie denominated, so we actually pick up the prevailing RBA cash rate. You pick up the raw price movement in terms of what the price has done over the course of the month, and the third return stream, of course, is the roll yield. What we've been able to do over the course of the last couple of months, or certainly since commodity markets have bottomed as of March this year, is that a lot of the returns initially have come from price movement, where we've seen a fairly aggressive rally in quite a few of the commodities, and crude oil is a great example of that, copper, sugar. We've also been able to actually pick up a return kicker from markets which are in that backwardation environment as well, and a great example of those particular markets where we've actually extracted roll yield profits are in markets like sugar, copper and lead. Crude oil is an interesting one because it's providing good opportunities from a price perspective, but the forward curve does still indicate that that market is still fairly well supplied at this stage, and that's been a situation where you can still generate a positive return in a market that's in a contango environment, albeit not as good as something like sugar. Now obviously the best opportunities come from markets which are exhibiting supply constraints, and that's where we're basically skewing the portfolio towards. So example, markets like sugar, lead, copper feature prominently in the portfolio because they're both exhibiting, or all three of those markets are exhibiting fantastic price opportunities, but also there's the added kicker of the positive roll yield as well.